What if I told you that trying to be generous to your kids could cost them $200 to $1,000 in taxes? I'm Tiffany Phillips, CPA and tax strategist, and I've seen too many successful women entrepreneurs making this devastating mistake with their biggest asset, their home. Today, I'm going to show you exactly why gifting your house to your children while you're still alive is one of the worst financial decisions you can make, and what smart business owners do instead to protect their families and save massive amounts in taxes. If you own a home worth more than what you paid for it, and let's be honest, in today's market, that's pretty much everyone, then you need to watch this entire video. Your kids will thank you later. Now, here's what most people don't realize. The difference between giving your house to your kids before you die versus after you die could literally be the difference between them paying $0 in taxes or hundreds of thousands of dollars. I'm going to walk you through a real example that will shock you, and then I'll show you the strategy that wealthy families have been using for decades to protect their assets the right way. But first, let me tell you why this matters so much to you as a successful business owner. As women entrepreneurs, we're not just business owners, we're creators. We take ideas, dreams, and visions, and we create something incredible from nothing. We create businesses that employ people, serve communities, and generate wealth. We create solutions to problems others couldn't solve. We create opportunities where none existed before. But here's what drives us even deeper. We're creating a legacy. The business you've built isn't just about the revenue it generates today. It's about the example you're setting for your children. It's about showing them what's possible when you refuse to settle, when you take control, when you build something meaningful. And part of that legacy is leaving them with more than what you had. Not just more money, though that absolutely matters too, but more opportunities, more security, more freedom to make choices based on their dreams rather than their limitation. That's why this decision about your home matters so much. Your home isn't just your biggest asset, it's part of the foundation you're building for the next generation. Here's the problem. Most CPAs won't tell you about these strategies because they're either too scared of the IRS or simply don't know advanced estate planning techniques. I've been in rooms where traditional CPAs have told successful business owners, just be grateful you have assets to worry about. That's not advice, that's dismissal. You deserve better. You deserve someone who understands that keeping more of what you've earned isn't greed, it's good stewardship. It's part of the legacy you're creating. Now, let me share something that happened to one of my clients. Let's call her Jennifer. Jennifer built a successful consulting business over 20 years. She bought her home in the year 2000 for $150,000. Today, it's worth $800,000. Jennifer thought she was being smart by putting her house in her daughter's name while she was still alive. She figured it would avoid probate and maybe save on some taxes. What Jennifer didn't realize is that she just set her daughter up for a potential $130,000 tax bill when she eventually sells that house. Let me explain exactly how this works, because understanding this could save your family a fortune. There's something called step up in basis that most people have never heard of, but it's one of the most powerful wealth preservation tools in the tax code. Here's how it works in simple terms. When you buy a house, your basis, think of it as your starting point for tax purposes, is what you paid for it. So if you bought your house for $200,000, your basis is $200,000. Now, if you sell that house for $600,000, you have a capital gain of $400,000, the difference between the two amounts. You'll owe capital gains taxes on that $400,000, which could be $80,000 or more in federal taxes alone. But here's where it gets interesting. When you die and leave that house to your children, something magical happens. The basis gets stepped up to the current market value. So, if your house is worth $600,000 when you pass away, your children's new basis becomes $600,000, not your original $200,000. This means if they sell it right away for $600,000, they pay zero capital gains taxes. That's right, zero. Even though the house appreciated by $400,000 during your lifetime. But, and this is crucial, if you give them the house while you're still alive, they take on your original basis of $200,000. Then when they sell it for $600,000, they'll owe taxes on that full $400,000 gain. Let me show you exactly what this looks like with real numbers. Let's use a real example that I see all the time with successful women entrepreneurs. Meet Sarah. She's like many of you watching this. She built a thriving business. She's smart with money, and she owns a beautiful home that she bought 25 years ago for $200,000. Today, is worth $1.2 million. Sarah has one son, Michael, and she wants to make sure he gets the house without any complications. Scenario 1. Sarah gifts the house to Michael while she's still alive. Sarah decides to be generous and puts the house in Michael's name now. A few years later, Sarah passes away and Michael decides to sell the house for $1.2 million. Here's what happens. The sales price is $1.2 million. Michael's basis, what Sarah originally paid, is $200,000. The capital gain is $1 million. Federal capital gains tax at 20% is $200,000 in taxes. Plus, state taxes in many states could potentially be another $50,000. Michael just got hit with a $250,000 tax bill because his mom thought she was helping him. Now let's see what happens if Sarah keeps the house in her name until she passes away. Michael inherits the house when it's worth $1.2 million. Because of the step up in basis, his new basis is $1.2 million. When he sells it for $1.2 million, the sales price at $1.2 million has a stepped up in basis of $1.2 million. I think you're getting the point here. The capital gain is $0, so there are 0 taxes owed. Sarah's decision to wait literally saved her son $200,000 or more in taxes. This isn't theory. This is exactly how a tax code works, and it's completely legal. But the tax issue isn't the only problem with gifting your home while you're alive. Let me tell you about another risk that could devastate your family. You lose control completely. Once you gift the house, it's not yours anymore. Your child could sell it without your permission, use it as collateral for loans, lose it in a divorce, have it seized by creditors if they have a financial problem. I had a client whose daughter went through a messy divorce right after receiving the family home as a gift. Guess what became a marital asset in that divorce? You got it. The family home that 3 generations had lived in. The next issue, care home fees aren't avoided. Many people think gifting their home will protect it from nursing home costs, and that's simply wrong. If you continue living in the house after gifting it, the government can still count it as your asset for Medicaid purposes. They call this deliberate deprivation of assets, and they're not fooled by these strategies. The next problem, gift tax issues. If your home is worth more than the annual gift tax exclusion, which is $19,000 per person in 2026, you'll have to file gift tax returns and potentially use your lifetime exemption. There's also the lifetime gift and estate tax exemption, which increased to $15 million per individual in 2026, or $30 million for a married couple. While that's higher than previous years, gifts that exceed the annual exclusion amount still count against this lifetime exclusion. That's because there's a much better way to handle this. Here's what wealthy families do instead. They use trust. Now, before your eyes glaze over thinking this is too complicated or too expensive, let me explain how this actually works and why it's so much smarter. A revocable living trust allows you to do some really critical, important things. Number 1, keep control of your property while you're alive. Number 2, avoid probate when you die. Number 3, ensure your children get this step up in basis. Number 4, protect the property from your children's creditors and divorces. Number 5, maintain privacy. Trusts don't go through public probate. So here's how it works. You transfer your house into the trust, but you remain the trustee. So you can live in it, sell it, refinance it. You have complete control. When you pass away, your successor trustee, often your children, takes over and distributes the assets according to your wishes. The house still gets to step up in basis because you maintain control until death, but it avoids probate and provides a much better protection than outright gifting. Let me tell you about another client, Maria. She's a successful business owner with 2 adult children. Instead of gifting her $900,000 home, she puts it in a revocable living trust. When Maria passed away 5 years later, the house was worth $1.1 million. Her children inherited it with a stepped-up basis of $1.1 million. They sold it 6 months later and paid 0 capital gains taxes. During those 5 years, one of her sons went through a bankruptcy. If Maria had gifted him the house directly, it could have been seized by his creditors. Because it was in the trust, it was completely protected. Now, some of you might be thinking, but what about estate taxes? Here's the reality. Most of you don't need to worry about federal estate taxes. The exemption in 2026 is $15 million per person. If you're married, that's $30 million you can pass on tax-free. Unless you're in that very small percentage of ultra-wealthy Americans, estate taxes aren't your problem. Capital gains taxes are. And for those of you who might be approaching those limits, there are advanced strategies we can implement. But that's a conversation for a different video. The key point is this. Don't make decisions based on problems you don't have while ignoring the problems you do have. So what should you do right now? First, if you've already gifted property to your children, don't panic. Depending on your situation and timing, there might be ways to unwind this or minimize the damage. You'll need to work with a qualified professional to do so. Second, if you're thinking about gifting property, stop. Talk to someone who understands both tax strategy and estate planning before you make any moves. Third, consider setting up a revocable living trust. This isn't just for the ultra wealthy. Any homeowner can benefit from this strategy. Fourth, make sure you're working with professionals who understand advanced strategies, not just basic compliance. There's a huge difference between a CPA who prepares tax returns and a tax strategist who helps keep more of what you earn. Here's what this really comes down to. As successful women entrepreneurs, we face enough challenges without accidentally sabotaging our family's financial futures. You've worked hard to create something meaningful. You've made smart decisions to grow your business and accumulate assets. You're building a legacy that goes far beyond just money. You're showing your children what's possible when you refuse to accept limitations. Don't let a well-intentioned but misguided decision cost your children hundreds of thousands of dollars and undermine the very legacy you're trying to create. The wealthy don't pay more taxes because they have to. They pay less because they know how to use the tax code to their advantage. These strategies aren't secrets, they're just not widely known or discussed. That's exactly why I wrote my book, Your Biggest Expense, to help the business owners like you understand that 99.5% of the tax code is written to help you, not hurt you. But you have to know how to use it. If you found this valuable, I need you to do 3 things. First, hit that like button and subscribe to this channel. I share strategies like this one every week that can save you thousands in taxes. Second, grab a copy of my book, Your Biggest Expense. The link is in the description. It covers 10 strategies that can legally reduce your taxes by 30% or more this year alone. Third, if you're a business owner paying more than $50,000 a year in taxes and you want to see exactly how much you could be saving, book a free strategy call with my team. The link is in the description. Remember, it's not what you make, it's what you keep. And when it comes to passing wealth to your children, timing isn't just everything, it's worth hundreds of thousands of dollars. Don't let well-intentioned decisions become your family's most expensive mistake. The legacy you're creating deserves to be protected the right way. I'm Tiffany Phillips, and I'll see you in the next video where we'll dive into more strategies that can help you keep more of what you've earned.